Waiting for answers on the economy, on Russia and Ukraine, on COVID, and of course, on the Fed. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on whether economic sanctions can change the facts on the ground in a place like Ukraine.
Often, unilateral sanctions can be a stop or I'll shoot myself in the foot kind of policy.
Sonny Beschloss and Rick Reeder take us through the rough ride in the markets. And Kevin Mayer of Candle Media talks about winners and losers in the streaming video wars.
The question is, on the margin, some of these smaller players who are trying to make headway globally, can they do it?
So far, 2022 has given us more questions than it has given us answers. As U.S. CPI numbers this week came in even higher than expected, an annual rate of 7.5%. That's the highest in 40 years, continuing to press the all-important question of whether we've overheated the economy with all that fiscal stimulus, and if so, whether we can bring it off the boil without doing serious damage, with Mike Wilson of Morgan Stanley saying that is the big question.
This is the $64 trillion question. How much tightening can the Fed actually do if growth is slowing?
And for all the high-level diplomacy this week gave us no real answers about Ukraine, with President Putin insisting he has not decided to invade and is willing to keep talking, while German Chancellor Scholz visited President Biden and came out saying Germany stood with the West when it comes to potential sanctions, although he didn't say what exactly everyone was united on.
We are acting together. We are absolutely united, and we will not taking different steps. We will do the same steps, and they will be very, very hard to Russia, and they should understand.
And when it came to COVID, the answers we got were a mixed bag, with a range of governors easing off on mask mandates, including Governor Kathy Hochul of New York.
At this time, we say that is the right decision to lift this mandate for indoor businesses and let counties, cities, and businesses to make their own decisions on what they want to do.
At the same time that Rochelle Walensky of the CDC was saying it recommends keeping the masks on.
At this time, we continue to recommend masking in areas of high and substantial transmission. That's much of the country right now in public indoor settings.
And what did all of this mean? Well, in the markets, it made for a truly wild week, starting with 3 days of relative hope and calm, followed by 2 days of real turmoil, as CPI numbers on Thursday drove yields up and stocks down, with the yield on the 2-year rocketing up 30 basis points on Thursday alone, only to have National Security Advisor Jake Sullivan come out Friday afternoon to warn that a Russian invasion of Ukraine could be imminent, despite what President Putin has been saying, which drove people back into bonds at the same time they continue to sell their stocks, which took the 10-year yield back down under 2 again, and sent the S&P 500 and NASDAQ sharply down, while Brent crude climbed over $95 a barrel for the first time since 2014. So where did we end up when the dust settled, more or less? The yield on the 10-year was back down to 1.9, just about where it started the week, actually, while the S&P 500 was off 1.8% and the NASDAQ was down almost 2.2% for the week. To take us through this very difficult week in the markets, we welcome now Sonny Beschloss, CEO of Rock Creek, and Rick Reeder, BlackRock's CIO for fixed income and head of the global allocation team there. So, Rick, I'll start with you. In a week full of surprises for most of us, what surprised you the most? What was the biggest surprise? That 2-year move on Thursday?
It's hard to count it up. Actually, if you go back to last Friday, we got the payroll report. You got a blockbuster payroll report. That was surprising in that you think about during Omicron, how many people could we hire? And you got this explosive number. Then the CPI report, as you said, which was a bit surprising. And we're moving away from reopening components driving inflation. It was pervasive across the board. And then the volatility that we just got today in and around the Ukraine situation. So, boy, this was, you talk about tumultuous weeks. This will go down in the Hall of Fame as one of them.
And Sonny, what did you make of all of it?
I agree with Rick. It's hard to say that one event was more turbulent than the other, because the whole really 7-8 last days have been equally turbulent. And as you said, to top it off was the news about Russia which impacted everything again drastically. Although it was interesting because we started this morning with interest rates going up in Russia for about 100 basis points. And I think that had already got the market talking about why was that happening today.
Rick, when it comes to inflation, what's causing it in your estimation? Because what's causing it will directly affect what we should do about it.
You know, David, clearly the demand function in the system is high, but more than that, you've got a set of supply components that is pretty dramatic today. I mean, obviously you got the supply chain shocks. You know, you look at components like rent, where there's just not enough inventory today. That's creating some of this dynamic. You know, obviously commodities, oil, input costs. And so you've got across the board set of influences that's probably going to stick with us for a period of time. I do think you're going to come down in the second half of the year. By the way, there's something, I was just looking at the University of Michigan data that came out. You know, it was the worst sentiment reading in 10 years. And when you look at things like time to buy a home or attractiveness to buy a home or a car, it's plummeting. So there's a really interesting dynamic at play. Prices are moving higher. It's dulling consumer sentiment, which is again why I think you'll see some shifting over the next few months away from these price increases are causing people to step back and say, gosh, I'm going to wait for a bit of time.
Rick, I was going to ask you, if you listen to Cecilia Rouse or others in the administration, the assumption was by the end of this year, the inflation rates could be about half of what we started the year with. Do you think we will end up the year at 3 to 4%, or do you think we'll be closer to 5%?
You know, when we do run all our analytics and we look at all the quantitative data that gets into it, we actually have it coming down to core PCE, depending on how you measure it, core PCE, core CPI, we have coming down to around 3. There's a few factors at play. One of the big one is the base effects. You know, when you look at year on year, that one will start to kick in. Some of the supply chain dynamics come off, and then as well as you would think that commodity prices will start to peak. So there's a series of factors that will bring it down. The thing that is pretty incredible, things like rent are hard to bring down because of the inventory dynamic. The other one that, you know, is going to continue to be with us is wages continue to accelerate. So listen, I think they're going to be sticky higher, but if you quantitatively, it does suggest we're going to come down significantly by year end.
Mortgage applications are down, right? By quite a lot, both for refinance and new homes. So that might
exactly right.
Well, as the rates go up, that's not going to help that situation much at all, right? As housing prices go up because of the cost of things. So Afsani, what about the wages, though? That's one thing that could be quite sticky, as Rick suggests. And we are seeing increased raises, although I must note, real wages are still going down, not quite as fast, but real wages actually went down last month.
You're so right, David. And what is interesting is while wages did go up by quite a bit, particularly at the lower end of income rates, in real terms, they're still down maybe about 2.5%. So there's still a long way to go for the lower end of wages to catch up, even though we have had this kind of progress. So I think the Fed policy, which was to try and look at inequality as one of the many dimensions of looking at employment and inflation as the two big, obviously, elephants in the room, I think is going to continue to be out there. And as we get new Fed members join in, it will be very interesting to watch the new dynamics.
Rick, I think you said that you sort of project core PCE down around 3% by the end of the year. I think it was the number you used. What are you assuming the Fed does in that world? Because that's the big parlor game right now. What should the Fed do and how fast?
Yeah, so I'll say a couple of things. First, I want to go back to what Afsani said, because she's dead right. What's actually happening with wages, it's actually, when you break it down, we break it down into deciles, income deciles. It's actually the lower end that's really appreciating in terms of income, which is actually great, which is actually quite healthy. You're closing the income gap. But like you said, you've got inflation that's picking up faster. Here's where the Fed has a real challenge. You don't want to shut off the economy. You don't want to move. You don't want to hike too aggressively. You don't want to drain the liquidity of the balance sheet too aggressively, because you want to persist this economic recovery. You want to persist this wage dynamic, particularly in lower and middle income. The question is, will you get enough natural reduction in cost pressures that will again expand the wage dynamic relative to inflation? Actually, if you go back pre-COVID or since COVID, it's actually what's happening is income is actually growing faster than expense. It's been the near, as Sonny said, it's the near-term dynamic that is painful. I think the Fed's got to get off of emergency conditions, got to get to neutral, and then look at a lot of data over the next 2 to 3 months. What's happening with inflation? What's happening with some of the supply chain dynamics, the cost pressures, the input cost pressures? And then again, not be too anticipatory such that you're shutting down the economy, because that can create more negative impact than you really want to do.
Yeah, Afsani, last word to you on this particular subject. A lot of people are saying there's no reason on God's green earth why the Fed should be buying bonds right now, and everybody seems to agree with that. But does it really matter? Is that really driving inflation at this point?
It's not driving inflation, but it's not at the same time doing anything, and it's not. It's helping certain parts of the markets, but also on top of what you said, David, particularly in mortgage markets. Why is the Fed buying, given the kind of hot market that Rick talked about and you talked about? So I think that should be one of the earliest parts of going to start with the QT and with the quantitative tightening. The big problem we have is there is very little experience with quantitative tightening. And I think the Fed is learning sort of as it goes along, and that is why it might be so late on that part.
Okay, Rick Reeder of BlackRock and Afsani Beshlas of Rock Creek will be staying with us as we go on to continue to talk about this really wild, chaotic week in the markets. We're going to talk about liquidity, and also, by the way, we better get back to Ukraine. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We are back with our roundtable of Rick Reeder of BlackRock and Afsani Beshlas of Rock Creek. We're going to continue talking about this truly extraordinary week in the market. So, Rick, I want to come back to you on something you've talked about repeatedly in the past, and that's liquidity and the effect of liquidity or lack of liquidity in the marketplace. Where are we in liquidity right now? How much of some of the volatility are we seeing is because people are withdrawing liquidity?
Yeah, David. I mean, that is part of why these markets are so volatile. There is no conviction in today's markets. And so what happens is markets tend to, I always look at top of the book liquidity, meaning in the equity market, how much can you execute at a price? And much of the time this week, it was a couple of $1 million worth. That number is usually many, many multiples of that. What happens is people, when you get all of these ambiguous indicators, where is growth going to be? How aggressive the Fed going to be? Gosh, now I just threw Russia, Ukraine into the equation. The liquidity in the markets go away. And part of why the liquidity in the markets go away, people always think about what's working in my portfolio, what's working as a hedge. And you think about what's happened this year. Bonds here, before today, bonds are going down in price. Equities are going down in price. How do I think about that? And how do I think about a hedge? Because you get something like the Russia-Ukraine thing, and all of a sudden treasuries rally. So whereas I'm worried about interest rates being higher, so you got to be careful about that as a hedge, because now they start to rally. It creates a dynamic in the market. There's not enough conviction. There's not enough hedging ability. There's not enough mitigants to manage risk. So you just got to bring risk down. You got to run smaller position, higher levels of cash. And that means the liquidity in the markets, because people don't have conviction, because people aren't putting as much money to work, then you have a market that is skin deep, and you got to be really thoughtful about how you want to execute in these markets.
Afsani, I wonder about you as an investor, because you invest in the longer term. It looks like we're going through a change in the paradigm right now, one of a lot of support, monetary and fiscal support for the markets, and it looks like we may be going away from that to neutrality or even some tightening. What does that mean for you as an investor? What are good investments in that climate? What are bad investments?
You certainly need to move to more active investment in this kind of period. And as Rick said, if we go back to pre-COVID days, we already were having some of these liquidity problems, right? There were, that was what we used to talk about before COVID. And of course, it's coming back with a vengeance. And so looking forward into the markets, as we're seeing, interestingly, global markets are doing better than the US this year. And even places like Europe and emerging markets, despite all the things that are going on, in both have been doing much better. Small cap. And then again, I think with what's going on geopolitically, I'm actually bullish on clean energy, because people are going to be investing in it as a as a hedge to what is going on right in front of our eyes right now.
Sonny, I want to pick up on the question of geopolitics here for a moment. At the very end of the week, on Friday afternoon, really the markets got very concerned, as we heard from the White House, that it's really decidedly possible, not certain, possible that Russia will be invading in some form Ukraine. We've talked a lot about inflation, whether it's transitory or more permanent. Is the effect on the markets of Ukraine transitory or not?
I think what happened this afternoon, and by the way, Jake Sullivan was so careful with his wording in the sense of what may or may not happen over the next few days or weeks, is that it increased uncertainty and volatility in the markets, right? So if we thought that, there were some people this morning and yesterday talking about 50 basis point increases, I think that is the sort of thing that is less likely to happen when you have a Ukraine happen or other events that might come up in the near future like that, because it just increases uncertainty. And the Fed, the one thing that it has shown is that it wants to go through this transition in a relatively stable way to the extent that it can manage. So I would assume that that is what they're going to be focused on.
Rick, what about the geopolitics of investing? We've seen a pattern here of the U.S. being the place to be compared to the rest of the world. A lot of people are expecting, as we turn here, it's going to go back to Europe. It's going to go back to emerging markets. There are going to be they're better investments there, in part because the valuations are lower. And by the way, their monetary policy in a lot of EM countries is quite different. Does this sort of geopolitical conflict have the potential to reverse that?
Listen, I'd say a couple of things. First of all, this is a pretty complex situation. Your question, Sonny, about transitory. My sense is this isn't going to get resolved. There's not going to be a checkered flag of it's free to get to move forward. So I think this is going to be with us for a period of time. And markets don't like that. Markets like to put things in boxes and understand, like, is the Fed hawkish, dovish, is the economy good, bad? They just want to put things in boxes. This won't be able to be put in a box for a period of time. So how do you invest relative to that? Listen, I mean, we like still investing in the U.S. We definitely believe the growth paradigm is better. You've clearly got a moving Fed, but you've still got so many opportunities, and particularly what's happened the last few weeks and things like technology stocks coming under such dramatic pressure. So we still prefer the U.S. In Europe and parts of emerging markets, there's still opportunities, but you've got to watch this play out for a period of time. So, we started to dip our toe into emerging markets, but very, very slowly. And the view was, gosh, we've got some time. A, you need to see where the Fed is going to play out. And B, when you have situations like this, you've just got to be really careful and slow to enter. And, take where you think there's convexity to the upside. You think there's real upside, dip your toe in a little bit, but you got to be careful about it because this could take a little bit of time to play through.
And definitely, if you have countries that have large amounts of US denominated debt, you want to be careful with those. If you have countries that are commodity based, you want to be, they're more interesting during this period, regardless of, what the commodity is. So you really have to be very actively looking at things. I think the period of passive investing, which we had over the last 10 years, is kind of relatively behind us. It doesn't mean you don't do any passive investing, but active investments become more important as part of your portfolio.
So, Rick, let me try to reach beyond my can here. Is it possible that we should have seen through the markets in part some of this coming in what Vladimir Putin has done since 2014, his first invasion of Ukraine, what he's done with his economy, in terms of things like dollar-denominated debt that Afsani just referred to, his foreign currency reserves, he's got a much stronger position today than he did back in 2014.
Yeah, the irony, like you say, David, is the fiscal situation in Russia is arguably better than it's ever been. It's actually arguably one of the best fiscal situations that you see in the world today. And so in a stable environment, investment in Europe makes some sense. The question is today, how long before we see that again? But you're definitely right. I mean, the fiscal situation is, and it's, by the way, it's part of why it was one of the darlings for a while. It was the darlings of the emerging market, both currency, interest rates, et cetera. And then like a lot of things in emerging markets these days, whether it's politics, whether it's fiscal dynamics, whether it's the amount of, as Afsani said, the amount of debt burden, a dollar-denominated debt burden, those things have been shifting around. That's why emerging markets is a good place to invest, but you got to be deliberate and you've got to be well measured in terms of where you're going.
Afsani, I hate to keep you short on oil, but how much of this is the price of oil? Because that's really good for Vladimir Putin right now.
No question that the current prices are helping put away money, but also I don't think they will last long. You're going through this winter, and you're going to be in March, and we're going to be on the other side of it.
Very important point from somebody who really knows the oil market very well. Thank you so much to Afsani Beshlos of Rock Creek and Rick Reeder of BlackRock. Really great to have you with us. Coming up, we look at the week ahead in markets around the world. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to take a look at what's coming up next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. Bloomberg TV will be live from the Singapore Air Show this week, where we'll speak with some of the industry's biggest names about the outlook for travel this year. The picture promises to be a murky one as governments respond to Omicron in vastly different ways. Markets such as Australia are slowly reopening, but others like China and Hong Kong remain stubbornly focused on COVID-0 strategies. Singapore also hands down its annual budget. Elsewhere, China, India and Japan release inflation figures, while we get fourth quarter GDP from Japan and jobs numbers from Australia and South Korea. On the earnings docket, BHP Group, Nestle India and Sands China. Now over to Danny Berger in London. Danny?
Thanks, Juliet. Well, it is another very, very busy week for European earnings. We're going to hear from a multitude of different industries. There will be Glencore, Carrefour, Heineken, alongside Airbus as well. Now, beyond the earnings picture, geopolitics will be in focus. It's a busy week for Olaf Scholz. After last week, he was in the U.S. in D.C. meeting with the U.S. President Joe Biden. On Monday, he'll be in Kiev, and the following day, he's set to be in Moscow to meet with Russian President Vladimir Putin. Now, the following 2 days, Wednesday, Thursday, there is scheduled to be a NATO meeting of defense ministers. So again, that's a 2-day meeting there. Now, we'll also hear from ECB speakers. That includes Chief Economist Philip Lane and, of course, President Christine Lagarde. Now over to Romain Bostic in New York.
Thanks, Danny. On the heels of this week's inflation report, the big economic data in the week ahead will be U.S. retail sales for January. The value of overall purchases is projected to have risen by almost 2% last month from a year earlier. This after falling by almost 2% in December. That report comes as we start to get earnings from retailers, including Walmart. Remember, Walmart in previous statements had outlined challenges with cost increases, labor shortages, and global transportation bottlenecks. Other earnings to keep an eye on include Airbnb, Cisco, Deere, Kraft Heinz, Nvidia, and Roblox. And finally, the Federal Reserve releases the minutes of last month's monetary policy decision. Those minutes may provide some clarity as to the degree of urgency policymakers expressed in combating inflation. David?
Thanks to Juliet Sally, Danny Berger, and Romain Bostic. Coming up, everyone is jumping into the streaming pool, whether it's viewers binge watching at home or media companies investing hundreds of millions of dollars in new content. But is it a good business? And what will it take to win? We asked Kevin Mayer, co-chair of Candle Media.
Still a lot of headroom for continued investment in content. The appetite from consumers is voracious.
This is Wall Street Week on Bloomberg. Video. It's the part of the media we've never been able to resist. And now, through the magic of streaming, we can have access to a virtually unlimited supply of it whenever and however we want. What started with Netflix was supercharged with the addition of big players like Amazon and Disney and a pandemic that forced us to stay home and binge watch. Leading to growth, Jonathan Carson of Antenna says is amazing.
The amazing thing that's happening in this market right now is just the acceleration of growth in subscription streaming in general.
But now the question is whether the trees can keep growing toward the sky, with Netflix getting hit hard last quarter for reasons not entirely clear, even to its own CFO, Spencer Newman.
We're trying to pinpoint what that is. It's tough to say exactly why our acquisition hasn't, kind of recovered to pre-COVID levels. It's probably a bit of just overall COVID overhang.
But whatever hit Netflix has yet to slow down Disney, as it reported higher subscriber growth than anyone expected, and CEO Bob Chapek said he expected more to come.
We expect that we're going to actually add more subs in the second half of the year than the first half of the year.
The one thing we know for certain is that whoever is up or down quarter to quarter, there's a lot of money being invested in a lot of content, raising the question which companies will prevail and how good a business will streaming end up being. And when it comes to video in the media world, there is no one, and I sincerely mean no one, who knows it better than Kevin Mayer. He is now the co-founder and co-chair of Candle Media. He's also chairman of DAZN. I knew him best back in the Walt Disney Company, where he was head of our strategic planning operation. He was the one who was with Bob Iger through so many of those strategic acquisitions. Kevin, thank you so much for being with us here at Wall Street Week. Let's start with streaming video. You know that so well. You helped amass that really armada of material, the content that Disney has now. We saw Netflix took a bit of a stumble. Disney subscribers, we don't know, they go up and they go down from month to month, quarter to quarter. But overall, are there too many players in this space? Does there need to be some consolidation or shaking out?
Well, nice to be here, David. Thanks for having me, as always. It's a pleasure. I would say the market for these streaming services on a global basis continues to grow. So I think you're right to point out that some months are higher and some are lower in terms of subscriber growth. And there's something called churn, where people, subscribers end their subscription either temporarily or permanently. So there's ins and outs of the business. And the U.S. market, where you are and I spend most of my time, has seen some maturity because these streaming services have been around for a long time. But if you look globally, there are many markets around the world where these streaming services are just being launched or still have a lot of growth in front of them. So I think you'll see on a global basis a fair amount of continued steady growth for the leading services. Having said that, not all of these streamers that have pretensions of being a big global successful player can make it. You have the big guys. You have Netflix, obviously. Disney Plus is already a success. I can't see that being dislodged in any way. HBO Max, Amazon through Prime has over 100 million subscribers. So there are big players. The question is, on the margin, some of these smaller players who are trying to make headway globally, can they do it? And I think you'll see some consolidation and some people just falling out over time.
Thus far, we've seen sort of a growth industry, and it's an investment phase. People are not talking about profits, making money off of it. They're talking about investing in order to acquire those subscribers you refer to. At some point, there has to be more maturity. Can these enterprises continue to invest in new content at the rate they're investing right now, given the revenue structure?
I believe they can. There's still a lot of headroom for continued investment in content. Netflix is spending probably almost $20 billion a year on content. I think the Walt Disney Company said in their last earnings that they spend, including sports rights and movies and television shows around the world, like $33 billion or something like that. It's a lot being spent. The appetite from consumers is voracious. And I think that will continue for the foreseeable future. It's been double-digit growth in demand for content for these streaming services around the world.
Kevin, some people have said that this streaming is sort of like the next thing after cable. We had broadcast, then we had cable, now we have the streaming. But there's one way it strikes me that it might be quite different, and that is how sticky the revenue is. In cable, as you know, at ESPN, as I recall, those rights agreements could go for multiple years, 5, 6, 7 years. You knew that revenue was coming in. Even in broadcast, so much of that's bought, at least for a year, you know it's coming in. Subscribers can come and go month to month.
They can, and they do. But again, I think the penetration rates, the overall level of subscriptions is progressing nicely in almost every territory.
Kevin, what has this streaming phenomenon meant for the cost structure of producing new content? I mean, I remember Dan Burke, who used to run Caption Davis. He said, sooner or later, all the money goes to the talent. What is this doing to what people are paying for writers and producers and for cast, for on-air talent and below-the-line talent?
Well, I think John Landgraf of FX called this peak TV, and that was a few years ago, and it continues to keep peaking. It's great. I think it's great news for the creative community. The more creative output that is required and the more valuable their services are and their talents, it's good. I do think there's plenty of headroom here for profitability to be shared among the players, talent, writers, on-screen talent, the streaming services themselves, and the producers of the content who manage the whole process. There is no lack of profitable headroom there. I think that's this is one of kind of a win-win-win situation that's happening now.
So Kevin, who wins in the end? Is it the one with the most toys? And by that I mean, for example, going back again to Disney with the acquisition of Fox on top of what they already had, they have an awful lot of content. Is it a game that goes to the person with the most content?
Content itself, you have to have content that appeals to audiences. I guess that's obvious. It goes without saying. Disney is the premier content creator on the planet, I think. And they have the brands that matter. They have the stories. There's ongoing stories with Marvel and Star Wars, and of course Pixar, which tells fantastic stories, and Disney itself, and the Fox, the Fox acquisition, as you said, which came along with National Geographic and the Fox branded TV studios. Great set of content. They are going to be a big winner. Those are brands that will continue to grow in value and resonate with audiences forever. I also think Netflix, has a model that's very difficult to repeat. They're a volume play. They have great product. They make a lot of it. It would be hard for another player to replicate that breadth of content. I think it would be hard, David, to find a consumer segment, a meaningful consumer segment for which Netflix doesn't have an incredible depth of content. And recreating that dynamic again would be very difficult.
Kevin, let me turn to a different part of your world here and talk about the really drop off $300 billion, as I recall, got dropped off of the value of Meta because of Facebook. And part of what we heard when those earnings came out was they're going to have to change their whole model, that they are going to have to go into video. Yes, once again, video, because they said they really are competing with YouTube and TikTok. In particular, you for a time ran the U.S. TikTok operation. So what does that mean for them to have to go into video?
Well, look, they've been in video. And this is user-generated content. These are the users, the audience themselves make videos. So they're not paying for the video, but there's a lot of bandwidth and there's a lot of expertise that goes into and tools that allow creators to make high-quality videos. And then the delivery of those videos in a stream, one after the other, requires an intensive version of artificial intelligence to make sure that you understand a customer's preference, a user's preference in real time, and can deliver the right video to the right consumer in the right sequence. That is extremely difficult. It's, Facebook has always, and Instagram, the other part of Facebook, has always depended on follows. You follow someone, you like their stuff, that's a very strong signal. And if you look at TikTok, it's a very weak signal. They look at the nuanced usage of the app and determine your preferences that way. And if they're going to compete against TikTok, they're going to need to get much better in artificial intelligence. But I also think the Facebook story doesn't end with competition and having to move over to video. There's a big issue with their ad targeting business. A lot of their revenue comes from, a lot of it is direct to consumer services, both for e-commerce and video services who are trying to acquire customers. And the rule changes on Apple and the privacy changes that we're seeing across the globe, most of it for very good reason, is making it more difficult to target those ads. And so it's getting much more expensive for advertisers on Facebook to reach their audiences. And that is a very substantial problem for them. So I think it's a multifaceted issue they're facing. And there's no easy solve, but they're an incredible company, and Cheryl and Mark are super smart, and I'm sure they'll figure it out.
Yeah, I mean, listen, let's be clear. It's a very big, very successful, very profitable company. At the same point, is the valuation off at this point? Because I wonder if the stock price really was based on an assumption or a set of assumptions that may no longer be true.
It might very well be. That might be the case. And look, that's already reflected in that valuation change that happened. Look, it's a competitive marketplace. TikTok is going to make big inroads with advertisers. Amazon is kind of a sleeper. They have a huge advertising business, both in their e-commerce ecosystem and outside of it. So the competition, which used to be Facebook and Google, and then everyone else, is now Facebook, Google, Amazon, TikTok. It's a competitive, the competitive intensity is increasing quite dramatically. And I think you're seeing that reflected in the stock price. And who knows where the valuation goes? I don't, pick stocks well. It's never been my core talent, but it is clearly there's reasons for that big drop, and it's going to be very interesting to see how the future unfolds for them.
Okay, Kevin, I really appreciate spending time with you. It was truly helpful. That's Kevin Mayer of Candle Media. Coming up, we wrap up the week with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we're delighted to welcome back now our special contributor, Larry Summers of Harvard, to Wall Street Week. Thank you for being with us once again, Larry. So the big news this week were those CPI numbers. Consumer price numbers came in 7.5% up year over year. Frankly, one of the things that struck me was durable goods were up 18.4% year over year. You've been talking about this, saying the Fed needs to get on it. Obviously, the Fed is behind it, as you said. The question now is, what do they need to do to catch up? Let me be very specific. Should they have a special meeting?
David, look, these numbers were in line with the numbers that we've had. I don't understand why people keep being so surprised when there's evidence that inflation is entrenched. This confirms just how far behind the curve the Fed has gotten. And this, along with the fact that it now looks like Build Back Better is in trouble, confirms what a serious error the excessive stimulus of last March was. Here's what I think the Fed should do. I think the Fed should have a special meeting right now to end QE. It is nothing short of preposterous that in an economy with 7.5% inflation, in an economy with the tightest labor markets we've seen in more than 2 generations, that the central bank is still, as we speak, growing its balance sheet. And I think the Fed could show that at last it really gets it by having a special meeting for the purpose of simply ending QE. It's not that the marginal purchases they're going to do over the next month are all that consequential. They're not probably very consequential at all. But I think the symbolism of ending it tomorrow would show that the Fed has gotten a major wake-up call. Can you imagine any conceivable reason why, in the face of what is housing price inflation faster than we had in the 2006 pre-crisis period, we have the government intervening to actively buy up and reduce the yield on mortgage-backed securities? That should be ended tomorrow. And it would be precisely the suddenness of the action that would cause it to signal that we were really very clearly in a new regime.
What about rate hikes? We also had Jim Bullard, the president of the Kansas City Fed, this week come out and say, look, I think we should raise rates by 100 basis points by June. And by the way, we should not limit it to 25 increments. What about raising rates? Should it be done before the March meeting? And should we be looking at things more than 25 basis point increases?
I don't think there's any need to do it before the March meeting. I think the Fed needs to be much more careful about the use of the forward guidance instrument in a world where it has shown itself to be so dismal a forecaster of what's going to happen in the economy. Most of the poor forecasting is not the Fed's fault. It tracked the consensus and reflects the inherent difficulty of forecasting. But nimble and humble does not mean making announcements about what you're going to do over periods of 6 months or a year in a highly volatile economy. And the Fed needs to go back to the old ways, which are much more about nimble and humble. I think it's a close call on the March meeting. I would be inclined to think that markets are going to increasingly build that in, And if they do, I don't think the Fed should be surprising them on the dovish side. And I don't think the Fed should be trying to guide them to the dovish side. So I think there's a good chance that there's going to be a progression towards near inevitability of the 50 basis points. And if so, that's okay. But if markets don't go that way, I also don't think that is a terrible thing.
Yeah, I should correct myself. Mr. Buller, of course, is president of the St. Louis Fed, not the Kansas City Fed. At the same time, we have some economists coming out and saying, let's be patient, let's not overreact. We had Paul Stiglitz actually this week come out and say, really, a lot of this will take care of itself. And insofar as it doesn't, instead of contracting demand through tightening monetary policy, we should expand supply through fiscal policy. You tweeted about that and said that that was a sort of wishful thinking. Give us your reaction to the supply versus demand side of the equation.
David, Joe Stiglitz is a brilliant Nobel Prize, richly deserved microeconomic theorist. But as a practical, data-driven macroeconomist, he's practicing tooth fairy economics. Of course, it would be wonderful if we could have more cars all of a sudden. Of course, it would be wonderful if the participation rate in the labor force suddenly increased. But here's the thing. You can only fill water into your bathtub to the size your bathtub is. And demand has got to be constrained by what we know about supply. And the way we tell how demand is doing relative to supply is we look at the behavior of prices. And they, and particularly wages, have been screaming red alert on demand versus supply for months now. And so it's preposterous wishful thinking to somehow suggest that all of a sudden we're going to conjure into being lots more supply. The administration's absolutely doing the right thing with its policies to try to clear things up in the ports and the like. Any bit of mileage we can get in reducing bottlenecks is all to the good. But to somehow suggest that that's going to be our salvation and we don't need to pay attention to the evidence of demand outstripping supply is just complete wishful thinking.
Larry, I want to sneak in one more here because we're all focused on the U.S. economy and inflation, but there are other things going on in the world that could affect the U.S. economy as well as geopolitics. Let's talk about Ukraine, that crisis brewing over in Ukraine. There's a lot of talk about sanctions, a wide range of possible sanctions, economic sanctions on Russia, if in fact it does move further into Ukraine. You were Secretary of Treasury. You had to supervise sanctions like that in other parts of the world. Do they work?
Sanctions, David, are usually a bad alternative, but they're sometimes the best alternative. There are provocations for which it's just not acceptable to mount no response, and in which it would be catastrophic to mount a kinetic military response, and that's what drives us to sanctions. What I think the Biden administration has been working very well at is trying to make sure that we multilateralize our sanctions, because often unilateral sanctions can be a stop or I'll shoot myself in the foot kind of policy, where we sanction the country, it hurts American producers, but it doesn't hurt the country because they're able to get the stuff elsewhere. So sanctions with a multilateral perspective, I think that's probably the right kind of policy, but I think the devil is in the devil's in the details. And I must say, having been critical of them in some areas, this seems to me to be something where, so far, the Biden administration is proceeding with great skill, care, and thoughtfulness, and I think that's an encouraging thing to me.
Okay, Larry, thank you so very much. It's such a treat to have our special contributor on Wall Street Week, Larry Summers of Harvard. Coming up, what makes this Super Bowl different from any in history, and what 100 million Americans can do with it for the first time ever. This is Wall Street Week on Bloomberg. Finally, one more thought. Once in a lifetime day. That's what NBC is calling this Sunday, because for the first time ever, the Super Bowl will be played during the Winter Olympics. And NBC, let's be honest, could use the help, given the Olympics ratings so far. They were down over 40% for the opening ceremonies, making it hard to cover the nut of the billions of dollars NBC has invested in the Olympics in its multi-year deal. So here comes the Super Bowl with a super matchup of the LA Rams playing in their new home stadium and the Cincinnati Bengals featuring a quarterback who's been in the league only 2 years.
This is only my second year, but I plan on winning a Super Bowl. 30-second
ads will be going for $6.5 million apiece, and judging from what we saw in the playoffs, a fair number of those spots will be for online gambling. From Eli and Peyton Manning for Caesars.
I would have hit him in the numbers, probably.
To Jerry Rice for DraftKings.
Oh, yes.
Online betting has been exploding in the United States, with 100 million Americans now able to bet legally online. And that certainly includes the Super Bowl, with wagers on the big game expected to exceed $1 billion. Something Commissioner Roger Goodell 5 years ago resisted, long after other leagues had changed their minds.
We have been on the record and have actually opposed legalized gambling. We don't think it's in the best interest of the integrity of our game. We know that fans want to know that when they're watching a game, they're seeing the real thing, and it's not being influenced by any outside forces. So we take that very seriously. We have a very strong policy in this area, and we plan to continue that.
Well, the times sure have changed. And if you listen to those in the industry, people like Jason Robbins, the CEO of DraftKings, well, they say it's just a matter of convenience.
Obviously, there's a lot of great experience in person that you get at a brick and mortar facility, and that's something that'll always appeal to people, I think. But I think there's a lot of benefit also to being able to do things on convenient terms.
But others, like former Congressman Bob Goodlatte of Virginia, worry about the damage online gambling could do to people and families.
Not believe gambling is a victimless activity. In fact, I think that online gambling in particular can be more destructive to families and communities of addictive gamblers than if a bricks and mortar casino were built next door.
So while SEC Chair Gary Gensler is worried about the gamification of stock trading,
we'll also, I think, hopefully be taking up what's called digital engagement practices, what some people call gamification, and what to do there.
How concerned should we be about the gamification of gambling on real games? That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.